What's going on? Welcome into another edition of Market Takes. I know you could have been anywhere in the world on this beautiful Fed day out here in New York, but you're here with me and I appreciate that. I'm Dion Raboan, reporter at the Wall Street Journal. We are breaking down today's FOMC decision, the Fed's decision, their policy decision on rates, the Fed choosing to raise rates by 25 basis points. This was really locked into markets, but we did still see some market reaction and we're going to talk through all that. Of course, we're going to talk about what the Fed did, how that aligned with expectations, and the market reaction. We're going to talk a little bit about the environment coming into this report and really how what the Fed did moved markets and how it could move markets going forward into the future. We're also going to talk about the Powell press conference and what we learned from the Fed chairman, and of course talk about what comes next, because we are always looking forward here on Market Takes, and that's what we do. So listen, before we go into any more complicated analysis, let's just first talk about what happened today. The Fed raised rates by 25 basis points. I want to throw a chart up here on your screen so you can see just what we're looking at in terms of action from the Fed. What you see there on the right of your screen, the rate coming up really at the fastest pace we have seen. A lot of folks say in modern history, but really when you talk about going from that zero level to where we are now, which is 5.25% to 5.5%, that's really the fastest rate when you think about where we've come from to where we are that we have seen in history. So this rate hike cycle is kind of unprecedented in history. And you see there it just kind of shoots straight up for the first few months, and then you get that sort of slow down and it looks more like an arc, more like what you had seen before in those previous cycles. You'll also notice there that those recession shadings are in there. You see the 2001 recession, that 2008 global financial crisis, and the Great Recession as it's known, and then that 2020 COVID recession, the shortest ever in history. Those all tend to coincide with when rates are higher. That doesn't necessarily mean that the high rates caused the recession or that we necessarily have to have a recession now, but do keep in mind with rates, as you see there on the right of your screen, the highest they have been since 2001. That is definitely something to keep an eye out for, because the economy struggles with those higher rates. It's harder for businesses to borrow money. It's more expensive, harder for folks to borrow money by borrowing from, against their home with those home loans. And so it's harder for people to get credit, harder for businesses to grow, harder to pay off some of those debts and those things. And so that tends to lead to a slower economy and a lot of times drives the economy into recession. That's not what the Federal Reserve wants to see. That's not what the data shows us, but it is something to just keep your eye out for. And this chart really just illustrating how far we've come in terms of raising rates and getting them to that high level that you see there, 5.25 to 5.5%, where we are today. Really, one of the biggest and most interesting things about the report wasn't even what we heard from the chairman. That's usually the big blockbuster thing. It's what we got in the Fed statement, the FOMC statement from the committee, which had almost no changes. Usually when the Federal Reserve makes a change, like last month they didn't raise rates, they held pat, didn't raise rates at all. This month they did, they raised 25 basis points. So when you get a change in policy like that, usually there's a long explanation. There's, we see this change in the economy, we saw that, this moved, our analysis has changed, our view of the economy has changed. This month's statement, almost nothing changed except for the fact that the Fed said, yeah, we raised interest rates to 5.25 to 5.5, which is how they'll put it in their statement. And they said the economy expanded, or economic activity has expanded at a quote moderate rather than a quote modest pace. Other than that, no real changes to the statement, and that was very interesting. You really did see the market start to take off after the statement came out and sort of start to come back down a little bit after Fed Chair Jerome Powell started to talk and really talk about what he was thinking about the market. But the statement with almost no changes locked in some of these market expectations, and really you saw stock prices go up, you saw those bond prices come down. Both of those things mean people are buying. When stock prices go up, it means folks are buying. When bond yields go down, it means bond prices are rising, which means, again, folks are buying. So that was interesting. We'll talk more about that in just a second. But that minimal change is unusual when the Federal Reserve makes a change in policy. Typically includes a lot of explanation. So what's next? Well, what's next is data dependence. Now, I know you all are here on Market Takes. You understand the importance of the data. You understand the importance of the CPI, PCE, the jobs report, all those things. But for a lot of folks who don't really follow the markets that closely, they could see some wild swings when we get the next jobs report, when we get this PCE report later this week, when we get CPI or PPI. Those could move the market a lot because we don't really know what the Fed wants to do. The Fed isn't sort of hedging in one direction or the other the way they usually do. usually there will be market expectations for, okay, they're saying this, but what we really expect is a hike. Coming into this month, we had a 100% expectation for at least a 25 basis point hike, and even a little bit of an expectation, 3.5% expectation for a 50 basis point hike. So there was no one in the markets who thought the Fed wouldn't raise rates today. That was priced in. The only question was, what would they say and how would that affect the outlook? And really what we heard today was Fed Chair Jerome Powell does not know what comes next. He is going to be all about inflation data, all about jobs data, all about retail sales data and growth data, all about housing data. And thankfully, we here at Market Takes are going to be here to break it down for you. So please stay tuned and stick with us. Those of you who have been watching Market Takes, I know you'll keep tuning in. Those of you who haven't, hey, tell a friend. You're going to want to know what's going to move markets, and that's going to be what we talk about from Market Takes. This really could be the first time that the Fed is truly data dependent. It's a phrase that they've used a lot. It's kind of been beaten into our heads a lot, but folks really a lot of times don't believe it. Investors and folks out there in the markets, they say, yeah, they say they'll be data dependent. And if this thing really overperforms, if we get a lot more jobs than expected or a lot less jobs or a supremely or significantly negative print, then they'll react. But this really shows us, and what we heard today from the chairman really sets us up to where it's all about the data. Individual reports are going to move markets and are going to move markets across the board. We're talking not just stocks, but bonds. We're talking currencies. We're talking commodities. Potentially even the crypto market could be moved significantly by some of these big releases. I want to point out one thing the Fed chairman said that I don't think really got a lot of play in the markets, but I thought this really caught me off guard. He talked about if we see inflation coming down credibly and sustainably, in his words, then we can move down to a neutral level or even below a neutral level. What that means is potentially rate cuts, as in moving the Fed funds rate back down. And here's why that matters is rate cuts are usually aligned with the start of a big takeoff in stock prices, with the start of a robust increase in stock prices and economic activity, and you usually see the economy take off, and you see even more than that, those stock prices take off and those other risk assets really take off. So Fed Chair Jerome Powell kind of saying, hey, even before we see inflation get down to 2%, which has been what they've been kind of hammering home and pounding the table on for the last few months. Even before we get to 2%, we're at about 3% right now on that CPI. But even before we get to 2, we could start to see some rate cuts from the Fed. He said it likely won't be this year, but you could start to see rate cuts from the Fed. That really hadn't been on the table previously before this meeting. So that's very interesting. He said he doesn't see that until around 2025 or so, of inflation getting back down to 2%. So even though inflation might be stuck around 3%, around 2.5%, 2.7%, so on and so forth, in those higher levels, the Fed has said, not acceptable, not good enough, we won't stop there. Now Fed Chair Powell is saying, well, you know what, as long as inflation is moving down sustainably and credibly, in his words, we could start to cut rates maybe as soon as early next year. And so that's a very interesting takeaway from this meeting. I thought it was a pretty dovish hike, not a supremely dovish hike, because again, it's all about the data. Going to be all about CPI, PCE, and PPI. That's the Producer Price Index, but going to be all about inflation. It's going to be all about retail sales, going to be all about jobs, and if those numbers are moving in the direction that the Federal Reserve wants them to move. So let's take a look at what's going on in the market right now. I want to put up here on your screen a chart, and just to show you what's happening in the market, we had a big deal move today. I think I got the Dow up here on your screen so you can see that. The Dow has risen for 12 straight days, is a closed higher for 12 straight days. Today is the 13th straight day that the Dow Jones Industrial Average closed higher. That is the longest streak we have seen since 1987. Those of you who remember 1987 know that that wasn't exactly a great year for the stock market, but in the early days before the big crash that we saw in 87, that was a big move. And so stocks are moving higher. This is a move and a winning streak for the Dow, specifically for the Dow, not all stocks, but for the Dow Jones Industrial Average, the 30 stocks that make up that. Those are a lot of industrial names, those big blue chip companies, up higher for 13 straight days. You see here the S&P 500 and the NASDAQ both ending the day lower. And what you'll also notice is the big pickup after the statement was released right on here, and then sort of coming down as Fed Chair Jerome Powell kept talking. And the market's kind of recovering a little bit, but not enough to get back positive. When we look at bonds and the movement in bond prices, you look at the 10-year yield here, pretty much across the board, this is the move you saw from the bond market. Right on here again, again is where we're seeing that 2 o'clock time frame, and you see bond yields just going down. And unlike for stocks, bond yields really staying lower based on what the chairman said. You see that even for the 2-year here in terms of what the action was right around 2 o'clock. Statement comes out here, and then you see the move lower in terms of bond yields, means prices are going up. We see when we look at currencies, we're seeing the euro going up, which means the dollar is going down. A weaker dollar is generally good for those stock prices as well. And when we look out at commodities really quickly, we see oil futures, not a big reaction here to the Fed's movement right around this 2 o'clock time frame. You don't really see a big reaction for a lot of commodities. But again, this just illustrating the market reaction that we saw and that we got overall from markets. And that was a bullish reaction. This was priced in, but I think a lot of folks didn't expect to see that statement from the Fed being as unchanged as it was. And I think that's really got a lot of folks in the markets excited. Let's talk about the press conference really quickly from the Fed chairman. The chairman's really, he said, data dependence. And I think he meant it this time. There have been some other times he said data dependence and folks were like, yeah, sure, data dependence. This time, I think it's really real. Stocks have been booming over the last couple months, and this was kind of the one thing that could have gotten in the way, but now we've got a number of other hurdles potentially in the path for stock prices to rise. But again, a number of things that could boost stocks even further. The Dow has only been up about 6 or 7% year to date, so it hasn't been a huge takeoff, even though the move has been overwhelmingly in one direction. But we haven't seen the Dow just take off and explode the way the NASDAQ has. NASDAQ is up over 30% so far this year, close to 35% just year to date, and we're close to the end of July. We haven't seen that move from the Dow, but definitely a positive momentum going into this meeting, and there will be positive momentum, I think, coming out of this. Want to talk about what I've termed soft landing summer. Let's put a chart up here on your screen really quickly, just show you what I mean, because it really can be encapsulated best with one piece of data. This is the CPI, the Consumer Price Index, and you see those numbers since June 2022. That's that high bar you see up there around 9%, just coming down consistently, and now we're at 3%, close to, that's the lowest level we had seen since early 2021. And really, that's exactly what the Fed wants to see. And this is how the retail sales data is looking. The jobs report is sort of looking similar to this, where the number of jobs added each month is declining, but you're not seeing just a tanking. You're not seeing these numbers end up in the gutter or really just start turning negative. What you're seeing is a soft landing, a deceleration, a steady decline towards more normal levels. And this chart, I think, really says it all. It illustrates what we've seen from inflation, which is inflation getting up and being high and then coming back down and now being at a level that's not quite at the Fed's target. Don't think the mission is accomplished yet. I think Fed Chair Jerome Powell would agree. Mission is not accomplished, but we are moving very strongly in the right direction. I think the Fed's message today was if this continues, rate cuts could be coming, and that's definitely something for investors who are bulls, who are on the bullish side of the stock market, betting long equities, can get excited about. The biggest takeaway from the press conference, I think, is the data dependence, and is just that every single piece of data is going to be very important. If we get a high CPI report, or if that core CPI comes in above expectations, that could really lead to a sell-off, and you could see movement significantly lower on the stock market. We are just in a macroeconomic environment right now where the data has consistently been positive and solid and told a good story about what's happening in the US economy. And if that continues, I think you're going to see stock prices continue to rise. You're going to see those bond yields continue to come down as folks keep buying, and that's a good thing on the macroeconomic side. But again, a report in the other direction could really jolt things, and you could see an overreaction, a knee-jerk overreaction in a lot of markets to that data. So you're going to want to know what those data points mean and what they say. Powell said during his press conference, he said the Fed will be data dependent. We're going to be dependent, quote, so much on the data, and we just don't have it yet. I thought that was a big moment from the press conference as well. Markets didn't react much, but really Powell kind of locking that in. If inflation keeps dropping to towards 2%, not to 2%, the Fed could start cutting rates. So what comes next? Well, tomorrow we have got the second quarter GDP report. That could, like we said earlier this week on the market look ahead, that could really confirm this soft landing summer. Expected to be right around 2% or 1.7% when we get the number on Thursday. If that comes in, that's again right in line with expectations, solidly positive, but not too high, not too hot, not too cold. It's just right, just what the data that we've seen so far has shown us. We also get the June PCE inflation report on Friday. That's in that personal income and outlays report. You're going to want to look out for that on Friday. That could move markets significantly if it's high, and if it's low, you could see markets really start to take off. We won't be doing market takes on Monday. I'm taking a little time off, but we will be back with you next week. So not this upcoming Monday, but the following Monday after that. Big jobs report coming out. You're going to want to look into that. So listen, that's going to do it for us here on Market Takes. I'm Dion Rabowen, reporter at the Wall Street Journal. Thank you all so much for being with us, and we hope you'll come back and join us next time.